behind us. I don't think the market cares about the trade war anymore. It's a snooze fest. We know what's going to happen. It's predictable, and not much is actually changing. I think it's a really good thing for society. I really do. I think our kids, people born post 2020, they're going to grow into a world, I believe, that's going to be a lot better than the world that we grew into. There are no ETFs that really track them or baskets that really track the trends that we're super excited about. So we're like, screw it. Let's go and make our own.
Hello and welcome to Being Exponential with Luke Lango, where we'll cover the markets, the economy, technology, and even lifestyle from an exponential perspective. I'm your host, Brooke. It's May 27th. Let's dive right in. We're going to kick this week off like we did last week with tariffs again, Luke. Trump just almost bluffed on the EU. He's talked about raising it by 50%, but then he kind of backed down. They delayed it till July. Now they're talking about it. You know, it always feels like, oh, trade war. Well, what do you think is happening, Luke?
Oh, what do I think happens? You know the story of the boy who cried wolf, right? I mean, you don't have kids, I do, but you know it's a story I know very well these days. Well, we got a president who cried tariffs, and the market is starting to realize that. Okay, the playbook here is so predictable. Trump throws a tantrum, issues these big, fat, scary tariffs numbers that would threaten to freeze global trade and destroy the global economy and the global economic system. But all that really is a chest puff to get the other side of the negotiating table. And to his credit, it actually works because guess what? Everybody wants to do business with the good old US of A, right? So Trump throws a tantrum, we get the tariff threat, the other side comes to the table, negotiations happen, and then boom, they come to a deal and the tariffs go down or they get delayed or they never happen at all and everything goes back to normal. So what do I think of this whole trade war nonsense? Well, I think it's nonsense, obviously, but I think we can kind of toss it in the rearview mirror. We can kind of put it behind us. I don't think the market cares about the trade war anymore. It's a snooze fest. We know what's going to happen. It's predictable, and not much is actually changing. We talked about it last week. There hasn't been a real read-through on inflation. And with all these talks happening and these deals getting done and these tariffs going lower, there's not going to be much of a read-through for inflation at all. Trade flows are still happening. As far as I'm concerned, I think travel is still happening as well. Consumers are still spending. So, yeah, I think it's business as usual is sort of what I'm looking at it. And I would not be concerned about any trade headlines we get in the next few weeks or months. There's probably going to be more chest puffing, and I would just write it off as chest puffing and then let the chest puff happen, let the negotiations happen, let deals get done, let tariffs go lower, and let stocks go higher. That's the recipe. So I'm ready to move past it. I think the market is too.
Yeah, that makes sense. It always feels like this particular government is instilling chaos into any given situation just to give themselves the illusion of control when, you know, people are like, oh, okay, we got to get stuff done. So what do you want? It feels like schoolyard politics.
Yeah, it is. It is schoolyard politics. And regardless of what side of the political aisle you fall on, I think you have to recognize that it works because we're a fifth grader playing with kindergartners.
Right.
The U.S. is so much bigger and so much more powerful and so much more diverse and so much more durable than every other economy in the world, even China, that we can afford to be the bully. Not forever, but at least for a little while. We can afford to be the bully, and other people will listen and they will bend and we will get the deals we want done. So you're right. It is schoolyard politics, but because we're a fifth grader playing with kindergartners right now, it's going to work, right? Again, it's not going to work forever, like 5, 6, 7, 8, 9 years, but it'll work for 5, 6, 7, 8, 9 months for sure. And we're seeing that in the past 5, 6, 7, 8 weeks. We have seen the U.S. get deals done that are favorable to the U.S. and tariff rates have gone lower and the stock market is back to where it was before the trade war even started. So, you're right about it being schoolyard politics. You're right about instilling chaos. You're right about all that stuff. Just for right now, you know, the big asterisk there is it is working. And the market's willing to look past, what is kind of organized chaos, maybe organized chaos. I'm not sure if it's organized or not, but whatever it is, the market's willing to look past it and focus on things that are actually driving value and creating growth, things like AI, things like quantum computing, which we'll talk about later in this episode. But that's sort of the best way to look at it, I think, these days.
Yeah. Speaking of the market looking past it, consumer confidence for the first time in 5 months is on the rise.
Yeah.
So it kind of speaks to, trade war, schmade war, right? Like, what do you think about the consumer confidence rising for the first time in almost half a year?
That's right. Trade war, schmade war. That's exactly that's what the consumer confidence survey says. So one of the biggest stories of the tape so far in 2025 has been falling consumer confidence. And it's more than just a fear-mongering headline. It was in the data. Mm-hmm. Like, consumer confidence did crash in 2025 to 5 to 10 year lows across pretty much every survey. There's two big surveys, University of Michigan and the Conference Board. And both of those, all the indices there were just, nose diving, and they fell to like 5 to 10 year lows basically across the board. So collapsing consumer confidence has been a big story of the markets this year. And it is a really important story because the consumer drives the economy. Okay. 70% of US GDP is driven by consumer spending. When people like you and me and our viewers feel good about the economy, feel good about their jobs, feel good about their incomes, feel good about where things are going to be in 6 to 12 months, have a sense of security about that, a sense of confidence in that outlook, then they spend. And when they spend, the economy turns. We go and we buy clothes, we buy cosmetics, we go on trips, we buy cars, we get homes, right? Like, we power the economy. When we are not feeling so hot, when we are concerned about a trade war potentially derailing the global economy, when we're concerned about a trade war potentially hiking prices of our everyday goods, then we stop spending, we stop traveling, we stop buying cars, we stop buying homes, we stop buying clothes, et cetera, and the economy freezes. The economy stalls, and that's how you get a recession. So a consumer-driven recession is a very it's probably the most common recession out there. And so that's why consumer confidence is super important. But the May Conference Board Consumer Confidence Survey sort of put those fears to rest, because it said, hey, trade war fears did kill consumer confidence, but now trade war fears are easing and consumer confidence is rebounding. And I actually want to show you a chart on this one. Here's the Conference Board Consumer Confidence Expectations Index in white. Now, so the way these surveys work, right, is they have the headline index and then they have two sub-indices, present conditions and future expectations. So they basically ask consumers, how do you feel about the economy today? And then how do you feel about where the economy is going in the next 6 to 12 months? The expectations index is always more important and more telling than the present situations index, because who cares how the economy is doing today? That doesn't influence your spending decisions. Your spending decisions are influenced by how you think the economy is going to shape up over the next 6 to 12 months. If the economy is good today, but you feel like it's going to be crap in the next 6 to 12 months, you're not going to spend money. You're going to save for that rainy day, for that bad situation in 6 to 12 months. So the expectations index is always the more important one to follow. Anyways, this is the Conference Board's Consumer Expectations Index. As you can see, the red line, this is going all the way back to the 1970s. The red line is what I would consider like an ultra low reading. Below 60s, like that ultra low level, reserved for very, very pessimistic situations. And then above 100, very optimistic situations where consumers are feeling really, really good. We kind of oscillate between, the red and the green, below 60 and above 100 kind of cycle. Now, as you can see, recently we plunged. So as recently as November 2024, right after the election, the expectations index was nearly 94. So close to that like super optimistic level. And since then, we just straight line nosedive. I mean, look at this complete crash all the way down to 55.4, which is the lowest since 2011. So again, like I said, 5 to 10 year lows. We were at a 10-year low, more than 10-year low, basically a 15-year low on the Conference Board's Consumer Confidence Expectations Index. But then look what happened this month, 55.4 all the way up to 72.8. We got a 17-point jump in 1 month in the Expectations Index. That's one of the biggest jumps of all time. Like, just looking at this, that's one of the biggest jumps of all time. And if this pattern follows, right, when we collapse down and then we rebound and then we collapse down and then we rebound and we collapse down and then we rebound. I mean, there's a pattern here. So we collapse down and now we're rebounding. It looks like this is the beginning innings of a big rebound in consumer confidence, which is important because I'm going to pull this next chart for you. What we just did is the Conference Board's Consumer Expectations Index jumped more than 15 points, 17 points, in 1 month after being below 70. So basically, we fell to super low levels and then had a massive 1 month recovery. That has happened 5 times before since 1970. This is what the stock market did in those 5 times over the next 12 months. Every single time, 5 out of 5 times, stocks were higher a year later. Average returns a year later, about 20%. So that's why that consumer confidence survey is so important. Again, we're in a consumer-driven economy, and if consumer confidence is in the early stages of a big recovery, which the data says it probably is, then this is probably what stocks are going to do over the next 12 months. They're going to rally like crazy. Now, what's really important is if you look at this data, look at the dates, these are at some major economic turning points.
Yeah, for sure.
2011, November 2011. That was right after the sovereign debt crisis kind of freaked everybody out on the heels of the great financial crisis. That was after that was over. Stocks rose 14% over the next year. April 2009, that was at the end of the great financial crisis. Stocks rallied 36% over the next year. April 2003, that was the end of that really long and nasty dot-com crash. Stocks rallied 20% over the next year. March 1991, that was at the end of the early 1990s recession. Stocks rallied 9% over the next year. And then February 75, that was the end of the first scary inflation wave in the 70s. And stocks rallied 22% over the next year. So it's not just the market action that stocks rally, but these were really major economic turning points. So it would make sense to add May 2025 to this list, the end of the trade war crisis and the beginning of a recovery from that crisis. So yeah, I think it's really important to look at that consumer data, and it gets me really bullish. Yet another reason I think that stocks are going to go a lot higher over the next 12 months.
Yeah, definitely. It just it seems like another slingshot, if you will, for anybody that's going to take advantage of it.
Right.
It's right there. It's in the numbers.
That's right. That's exactly right.
Yeah. Okay. Let's keep going on to jobs. We talked about these last week, but this week I want to touch on Agentic AI.
Right.
We mentioned the AI job apocalypse, and you talked about how it's more or less restructuring of things that are happening. But with the Agentic AI, it just feels like they are actually in a position to take more tangible jobs. So I want you to touch on that and see how our viewers feel about it.
Yeah. So Agentic AI, just quick definition. There's AI models and AI agents. AI models are things that complete kind of one-off tasks. You ask you ChatGPT something and it comes up with an answer. You ask it to do something and it does it, but not in a step-by-step fashion. Like you kind of have to guide it through steps. AI agents are full systems that act autonomously. They're AI systems that act autonomously. So they're AI agents that can plan your full marketing campaign. AI agents that can run your entire website. You don't really need to do anything. You just kind of give it instructions on the onset, on the get, and then it does everything. AI agents that can craft entire sort of branding reach outs, if you will, or social media campaigns, or design whole podcasts like this one. That's what an AI agent is. So fully autonomous systems. And yeah, to your point, there is a fear that these systems could actually take jobs because they act fully autonomously. But still, there has to be an instruction giver, right? These things aren't going out and deciding what to do on their own. They are doing things on their own after they've been given an initial set of instructions. So agentic AI, I think, is huge. I think there's two kind of next phases of AI. There's physical AI and agentic AI. That's where we go in 25 and 26. There's going to be a lot of growth in the stocks in those arenas, physical AI and agentic AI. But I do not think that either of them really represent a major risk to the labor market because human instruction is still required. And we get back to what we talked about last week: vibe coding, vibe working. the skill sets of the labor market completely get restructured in the era of AI. That means temporary and significant job loss, but not permanent job loss. It's going to require a massive reskilling, like the Industrial Revolution, really. It's going to require a massive reskilling, and I think people are just going to upskill. And really, to me, that's a really good thing for society, because some people really like to code. Most people do not. Okay? They do it because it's a profession and a way to earn money. Some people really like to write news articles. Most people do not. They do it because it's a way to make money. It's a way to earn a living, pay the bills. What I think Agentic AI is actually going to unlock for society is people are going to be able to do what they really enjoy. Like, they're going to be able to use AI to take their passion and actually make a living from it. And I think that's a really cool aspect of artificial intelligence from a societal perspective. I think it's going to allow us to do more of what we enjoy, just like the Industrial Revolution did, several hundred years ago, where it was like everybody was working in factories. Nobody enjoyed that work. It was dangerous work. It was awful work in the mines and factories, things like that. And then we got machinery to do that, so people could take jobs like desk jobs or sales jobs or different jobs that were not as laborious or bad for our health as the pre-industrial revolution job. So I think it's kind of like that shift. We shift not left or right, but we shift up in terms of labor. And I think that, again, short-term pain, a lot of transition going on there, but medium long-term, I think it's a really good thing for society. I really do. I think our kids, people born post-2020, they're going to grow into a world, I believe, that's going to be a lot better than the world that we grew into. And I'm really optimistic for the children these days. My kid's under 5 and 2. Maybe I'm just being optimistic for them, but I do feel very positive about the direction of the labor market for people like my children.
Awesome. Yeah. I guess I still want to play devil's advocate on the topic, because a lot of people are worried. Do we think it'd be an equitable transition of opportunity for everyone in the labor market, right? Do you think it could possibly be a consolidation of work, or can you maybe express an ideal vision of what AI would look like for our labor market in 15 years, 20 years?
That's a really interesting question that I don't know the answer to. But I think if I had to venture a guess, labor market transitions like this they do open themselves up to manipulation and abuse by those that see it coming before others. And so there is a risk for, a further wealth gap divide. There is a risk for more consolidation of power and value and money and wealth amongst, the tech elite, if you will. And then the rest of us just, kind of have to follow along in their pathway. So will the transition be equitable? I can see one way in which it will not be equitable at all, in which it'll just result in further consolidation of power amongst the tech megas. And you're seeing that in the market, right? Like the NASDAQ is absolutely soaring. The Mag 7 stocks are absolutely soaring. Yet the small cap Russell 2000 hasn't basically done anything in like 2 or 3 years. Like, it's actually, let's look this up real quick.
Yeah.
The Russell 2000 is at 2000. Funny. It's at 2084. It was at 2084 in January of 21. So the Russell 2000 small cap stock index has gone nowhere in 4 years and 4 months. That's pretty crazy when you think about how much a stock like Nvidia has rallied in that time, how much a stock like Meta has rallied in that time, how much Amazon has rallied in that time, how much even the smaller players, Supermicro, IonQ, how much those stocks have rallied in that time. It's pretty wild that small caps have essentially gone nowhere in 4 years and 4 months. So maybe you're already seeing the markets say this transition of the labor market will not be equitable. It will rather very much unfairly benefit the already powerful tech companies at the disadvantage of everybody else. Maybe the market's already saying that. Maybe that's what it's saying with this price action. But then again, there's also another pathway where because the rules change so much, it kind of opens up the game for everybody. It's like just because you were good doesn't mean you are going to be good. And all of a sudden, it's like the barriers to entry do get removed, and now anybody can truly be anything or do anything with agentic AI. So that's the more optimistic slant on it. I think both can be true at the same time. And I think maybe what the market is saying actually is that not enough companies in the Russell 2000 are harnessing the power of agentic AI to drive further value in their companies. I mean, when you look at profit margins, the NASDAQ companies, the tech companies, NASDAQ 100, biggest 100 tech companies in the world, their profit margins have been soaring in the past 2 or 3 years because of AI. They're using AI to find business efficiencies, unlock business efficiencies, and raise revenues without raising costs, and profit margins are expanding. I think their average profit margins have gone from like 18 or 19% to 24, 25% in the last 2 or 3 years because of AI. Meanwhile, the Russell 2000 hasn't seen any bit of a profit margin lift. So maybe what the market is actually saying is, yes, this is an opportunity for everybody to play catch up, but not everybody is. And therefore, we are rewarding those who are using AI innovatively to drive efficiencies and punishing those that are not. So maybe that's what's happening, if that makes sense.
Yeah. So it could potentially be a case of we're still waiting on the ripple effects of more. I would even go so far as to say even small business mom and pop shops to start using AI to like upscale their businesses. So maybe once that happens, we will see a shift, ideally, because small businesses are a building block of this country. I'd like to say. So it's a case of the AI hasn't been distributed because of awareness and not because of a malicious plot or anything like that.
Yeah, I would say it's an awareness thing because access is there, right? I mean, anybody can get ChatGPT. Anybody can pay $20 a month for their premium or go up to their pro at $200 a month or their enterprise or whatever. Claude's out there, Gemini's out there, Grok's out there. Like these models are out there. Everybody can access them. So accessibility is not the issue. I do think it's awareness. And I think that, I don't know why small companies aren't using it. Like they absolutely should. Look at the benefits it is reaping for a company like Meta. That company was on the brink of death. Like, do you remember a couple years ago when it was just like, they tried to pivot to the metaverse and that was a complete flop and they were spending all this money on their vision labs or reality labs, whatever the heck that division's called. And Zuckerberg was on Capitol Hill constantly facing questions and parents were boycotting Instagram. Like, that company was on the brink of death. And now it's soared, 5X, 6X since then in, 2 years. And it's one of the most powerful companies in the world, biggest companies in the world. And Zuck's, at the right hand of Trump. It's like, geez, like take cues, like take note, small companies. Yeah. If a big company can do that, a small company who doesn't have as much overhead can definitely pull off a transformation like that. And so, I would love to see small companies get more aggressive with their use of AI. And I think it will happen. And the ones that do are going to obsolete the ones that don't.
Definitely. Yeah. So it's awareness. I'd say a certain amount of personal responsibility. You got to take advantage of AI. Don't let it take advantage of you. So I want to move on to the price action. We just talked about that a little while ago. Everything seems a bit calmer. Everything, it seems like, we're past the trade war. What's your outlook on price action in general, looking forward? Yeah,
I mean, I would say that, hey, we are past the trade war. I do think we can put that in the rearview mirror. The S&P 500, NASDAQ, Dow Jones, they're all back to where they were before the trade war. The only one that's not is the Russell 2000. So again, small caps lagging. But Dow, NASDAQ, S&P all back to pre-trade war levels, blasting higher, a lot of upward momentum, a lot of good technicals. I just think that, the price action has calmed down and it's becoming positive. And I think we're going to get tax cuts, and I think we're going to get deregulation. So my whole theory kind of coming into the Trump 2.0 era was things were going to play out like the Trump 1.0 era. If you remember Trump 1.0, stocks did fabulously in 2017 amidst a wave of business optimism, deregulation, and tax cuts. 2017 was the year we got his big tax cut package. Great year for stocks. But then in 2018, the tariffs showed up and they kind of derailed that rally of 2017. And then the Fed had to fight the tariffs, and there was rate hiking going on, and the economy slowed and inflation picked up, and all that ended with a massive crash in late 2018. I thought we were going to get that. I thought we were going to get boom and then bust. But what ended up happening is we actually got the bad stuff first, okay? We got the bust first, which is actually, if you're an investor, it's kind of like, wait, that's a good thing. We got the bad stuff out of the way. Like, we got flushed and now we've recovered. The bad stuff is in the rearview mirror. Now we can shift to the good stuff, right? Double-edged sword of Trump. The bad stuff was the tariffs, protectionism, trade war crap. Got that out of the way. The other side of the spear here, the good side, is tax cuts, deregulation, business optimism. I think we're now going to get into that, and we're just now getting into that. So I think that markets are actually on a launching pad for a 2017-like rally from here in May. So year-to-date stocks are about flat-ish, but I think that between May 25 and May 26, I think we go up, 20, 30%. I think we have a big rally on deck thanks to tax cuts, trade war de-escalation, deregulation across businesses, business investment, strong business confidence, rebounding consumer confidence, and then just continued positive developments in a lot of the tech trends that we follow, whether it's quantum or nuclear or AI or eVTOLs, whatever it may be. I see a lot of growth in those trends. So price action wise, I love what I'm seeing, and I think things are only going to get better. Eventually, we are going to get a bust here. People got to understand that, okay? No boom lasts forever. Booms do turn into busts. The question is, when will the bust happen? And I think the bust is not going to happen in the next 12 months. What am I waiting for? IPOs and M&A activity. Manias like this bust when IPOs and M&A activity go crazy. Because what happens is you have the mania. There's a lot of private companies that are born in the mania. A lot of those private companies are worthless and complete dog crap, yet they take advantage of the hype. And there's so much hype that these dog crap companies IPO and investors buy up their IPOs, and you have an IPO frenzy. And then there's a bunch of M&A activity, and this company buys out that company, and it ends up being a horrible deal. 5 years down the line, we learn it's a horrible deal. But at the time, everyone's just hyping it up. These manias tend to burst when you get a bunch of IPO activity and a bunch of M&As. We are not there yet. The IPO market is thawing. CoreWeave, Hinge Health. There was one from Ryan Reynolds that was a SPAC that did really well. So there's some thawing in the IPO market, but it's not an IPO frenzy. We got an IPO frenzy in 2020, 2021 with all those SPACs. We got an IPO frenzy in late 99 at the tail end of the dot-com boom. These things end with IPO frenzies. We do not have an IPO frenzy yet. So I'm watching that IPO market very closely, the M&A markets very closely. Once those get red hot, I get really worried. They're not red hot right now. So long as they remain kind of tame or at least tempered, then I say it's all systems to go for the market.
Interesting. Yeah, so the IPOs are almost a telltale of potential grifters taking advantage of the wave. So when you see those, it's time to
it's simultaneously a sign of that and investors being so blind to the risks that they just buy up these crappy IPOs.
Yeah,
like CoreWeave is a good company. CoreWeave is a really good company. They had a really successful IPO. That's not what I'm talking about. Like in 99, you had pets.com and Webvan and all these ones that were just worthless companies that IPO'd and everybody bought them up like crazy. Or in 2021, we had all of these SPACs that were completely worthless that everybody bought up, and they ended up being worth nothing. But people were buying them up like crazy because investors were not paying attention to the risks. They were so much involved in their own greed that they just bought up anything that said it was going to be the next big thing. And we're going to get to that point here with AI soon, eventually, but not yet. And I actually think it's kind of funny. I don't want to play politics here, but I think the fact that Biden was president for 2 years really added longevity to the AI boom in a very odd way. That a lot of people out there, a lot of business people, a lot of investors, a lot of economics-oriented folks, business-oriented folks, just kind of thought Biden didn't know what he was doing as president, and so they didn't allow themselves to get greedy. Consumer confidence and business confidence were pretty depressed. They weren't awful, but they weren't great. I mean, let's go back to that consumer confidence chart that I had up here, the Consumer Expectations Index.
Yeah, definitely.
We're back here. So here we are, this is where we've been. Let me zoom in. This is where we've been in the last 2 or 3 years. I mean, this is amidst the market going absolutely crazy. Not these super optimistic levels we saw in 21 and 2017, 2018. No, like a pretty subdued level. That subdued level of consumer enthusiasm and business enthusiasm, I think, prevented us from going off the cliff. Because you don't drive off a cliff when you're tiptoeing and cautious. You drive off a cliff when you're, drunk at the wheel going 70, 80 miles an hour, right? That's when you drive off the cliff. That's when car wrecks happen. You don't get in a car wreck when you're going 5 miles an hour and being super careful. We've been going 5 miles an hour and being super careful in the last 2 years because I think people just weren't confident in the administration. So weirdly enough, I think that and then the trade war happened with the new administration. So people are like, wait, I don't even know if I can trust this administration on a business side either. So it's kind of this weird political dynamics, or people are kind of distrusting of the government, actually has helped, I think, add longevity to this boom. I think that changes in the next 12 to 24 months as the trade war kind of goes into the rearview mirror. I think we start to see people get like overly optimistic in this administration and overly optimistic in the pro-business policies and the deregulation and the tax cuts. And amidst that over-optimism is when you have to get worried. We're not there yet. Like I said, we may get there. When we do get there, that's when you're going to see me clicking the sell button and saying cash in those profits because this boom will bust. So yeah, this is an interesting kind of side note observation amongst all this stuff.
Yeah, interesting. I think it's the Buffett line: be fearful when others are greedy, and then greedy when others are fearful. Is that right?
I would say that's correct, but the timing element of it is super important.
Right.
The timing element of it is super important because a lot of people would say that there's been a lot of greed in the markets, maybe not amongst consumers or businesses, but at least in the markets over the last 2 years. And I say don't run away from that because I think this greed can continue. At some point, it hits a boiling point, hits a tipping point. Again, for me, the tell is going to be the IPO market, the M&A market. That's going to be the telling point. But we're not there yet.
Gotcha. Okay. Yeah. So on from there, I want to move on to exponential technology. And now I know you are excited about AI glasses. We mentioned them last week. It is the nexus of infusing AI into our daily lives outside of our phones. I want you to expand on that.
Yeah. So my theory is that the smartphone is dead. That this thing, as wonderful as it's been for as long as it's been wonderful, massively convenient, massively awesome, is dead. And it's dead because AI doesn't need it. This thing, this smartphone, even these computers, they were built for the era of, the internet. These computers are built for the era of the at-home internet, really, and the phone was built for the era of mobile internet. And it was all about touchscreen interfaces and app icons and doing things through screens. And I think the world is rejecting screens now. I think we're moving past screens. I think we're getting to something better. And that something better is going to be some AI-infused ambient technology, because AI does not require screens. AI, you talk to AI. AI observes. AI just kind of sits in a room with you and takes in its surroundings, kind of like a person. People got along just fine without phones before the internet. AI can get along just fine without phones too. And I think it's going to actually succeed in a world where there are no screens. So I'm getting really bullish on a new form factor of consumer technology to replace the smartphone. I think the smartphone's dead. What is that form factor? Still to be determined. But the world, or at least the big tech companies, seem to be voting and saying it's going to be glasses, AI glasses, which makes a lot of sense to me because, again, AI is ambient. It's non-disruptive. It's integrative. That's what glasses are, right? Glasses just sit on your face and they just observe. They see what you see. You can talk to it. And so I think the future is going to be these AI glasses. You're going to put glasses on. They're going to have little cameras and sensors in them, super lightweight. So not the bulky things like the Snap spectacles of yesteryear, but rather these really complex, lightweight, sophisticated smart glasses, AI glasses. They have AI chips in them. They have cameras. They have other sensors. They sense your surroundings. And you don't control it by speaking to it, but rather there's some holographic display that pops up and you either control it like here, or Meta is working on something where you kind of like, you put something on your fingers and you kind of control it down here, so you don't have to like put your hands up and it's, interruptive to your experience in the real world. But your display pops up as you're looking at through your glasses and you kind of control it down here beneath the table, and you're just kind of, scrolling with your mouse there. Okay, click that, click this and that. So you can do everything quietly. You don't have to talk on the subway to your AI glasses. You can if you want, but it's going to be controlled without voice. I think that's the future. I think that is the future that big tech is building right now. Like I said, Meta is doing it with Ray-Ban, the Meta Ray-Ban smart glasses. Those have been red hot. They have their Project Orion, which I just talked about, holographic glasses controlled by, kind of finger movements away from the glasses. Google announced they're teaming up with Warby Parker to make AI glasses as soon as 2026. Amazon has the Echo frames with Alexa. Apple is reportedly working on its Apple Glasses project. And then the big news of the past week is that OpenAI, it's been rumored for a long time that OpenAI is working with Johnny Ive, the guy who made the original iPhone. Well, last week that partnership kind of got cemented, did get cemented, because OpenAI bought Johnny Ive's AI design startup for $6.5 billion and put Johnny Ive in charge of all creative at OpenAI with the big task of creating a new generation of AI hardware devices. It sounds like they're not going to be creating glasses. It sounds like it's going to be maybe like a pin or something wearable. I'm not exactly sure. It'll be interesting to see what they cook up. But nonetheless, we are moving past the era of the smartphone. My money's on glasses. It might be a different form factor, but it's going to be something ambient. It's going to be something non-interruptive. It's going to be something with an integrative experience, and it's going to be huge. Whoever wins that race is going to dominate the world for the next 10 to 15 years. Because let's rewind here. Mid-2000s, the smartphone race, BlackBerry, Nokia, Apple, Microsoft, they all had devices, smartphone devices. They were trying to win that smartphone race. Who won? We all know the iPhone won. We all know Apple won. Well, what did Apple stock do from 2007 to 2021, 2022, 2023, 2024? Absolutely soared, went up like a rocket ship. And you know what went up more? It's suppliers, companies like Qorvo, companies like Corning, companies like Broadcom. Those companies that supplied parts for the iPhone, the whole iPhone ecosystem, birthed a bunch of 10x, 20x, 30x, even 50x winners in the 2010s. I see a similar situation playing out with AI glasses in the 2020s into the 2030s. Right now, the race is really competitive. Meta, Google, Apple, Amazon, OpenAI, etc. They're all in the race. One of them is going to win. I don't know who. Far too early to tell. One of them is going to win. Whoever wins is going to dominate for the next 10 to 15 years, the whole AI ecosystem, and the suppliers for that winner are going to see their stocks absolutely soar. And that is why I will be paying very, very close attention to the whole AI glasses trend right now, because you got to identify, or at least try to identify, who is going to be the winner. Find their suppliers, and then hop on their suppliers, because those suppliers are going to be big time winners in the next 10 to 15 years. So I'm really bullish on this whole AI glasses trend. And I really do think that maybe some of the biggest stock market winners of the next 10 to 15 years have not already emerged, because they're quiet or silent suppliers for what could be the next big project, the big project of the AI era, which is a new smartphone, or the next smartphone, if you will.
The next smartphone. So classic picks and shovels play on that. I wouldn't be doing my job if I didn't bring up the Humane AI pen.
Yes.
That came out, I believe, last year, but it was an absolute flop.
Mm-hmm.
Why? I'm assuming it was too early. It was too early, or maybe their marketing, their branding, their UI. I don't know. Personally, I don't know what went wrong. So, but how do we avoid that? How do these companies avoid that, or how do we know that's not going to happen again with, say, the Meta Ray-Bans?
Well, why did the Humane AI pen fail? It sucked. It didn't do what it said it was going to do. The tech was awful. It was glitchy. There were tons of customer complaints. It wasn't that people didn't like the form factor. It was that it just sucked, right? Like you could have had a smartphone come out in 2006 that looked just like this thing. But if it didn't do what this thing does, people wouldn't have adopted it, right? If it was just like, wait, the buttons are breaking all the time and it was horrible, they'd be like, you know what, screw this product. I don't care about it. Well, that's what the Humane AI pen was. It was a flop because the product actually itself just sucked. It did not do what it said it was going to do. How are the other companies going to avoid that? Well, resources. Humane was a tiny startup with limited resources.
Yeah.
The companies building this stuff we're talking about right now are not that. We're talking about the biggest, most powerful companies in the world with the deepest pockets and the best engineers and all the money in the world to spend on this project. They are not resource constrained. They will not reach the end of their cash piles and their cash coffers. So they're going to pour a lot of money, a lot of resources, a lot of time, a lot of attention, a lot of effort into this project. And I think they're going to produce something great. The Meta Ray-Bans are decidedly not a flop. Sales are up, I think 3x year over year, according to the most recent filing. Their sales are surging. People love them. People who wear them love them. The customer reviews are high and strong. So you're getting early proof points that what they're doing is working. And the fact that they have all of this money, all of these resources, just tells me they're going to be successful here. Somebody is going to be massively successful here. It's not going to be Humane. It wasn't Humane. They were the first, okay? And that's a flop. The first is never the right one. It's always the third or fourth or fifth that ends up being the winner. The iPhone was not the first to the smartphone race. It was sixth or seventh. Like it was way down the line, right?
Yeah.
So from that perspective, I'm not concerned about what the big boys are cooking up. They're cooking up good stuff, not the next Humane AI pen. That was a flop because the product sucked. What the big boys are cooking up is going to be really good, in my opinion.
Definitely. Now, I did also want to touch on this week. You have some proprietary indices. Let me take a look here. Yeah, you've been cooking up some stuff behind the scenes. Some proprietary stock indices to track some of these tech trends. I'd like you to touch on that.
Yeah, sure. Yeah. So one of the things that we're realizing is there's a lot of really awesome emerging exponential tech trends in the market right now. There are no ETFs that really track them, or baskets that really track the trends that we're super excited about. So we're like, screw it. Let's go and make our own, right? Let's slice up the market the way we want to slice it up by making baskets of stocks that focus on the tech trends that we are really excited about. Of course, the first one is artificial intelligence. So what we did there is we created 3 different AI baskets. the AI Foundational 5, the AI Builders 15, and the AI Appliers 15. The AI Foundational 5 includes the 5 big tech companies that we think are building the foundation for the AI boom. They're making those foundational models that are the foundation for all other AI models out there. They have the compute, they have the infrastructure. They are just the foundation for the whole AI boom. So that's the foundational 5. The AI Builders 15 is our collection of what we view as the 15 most important AI builder stocks, or AI stocks that are building the infrastructure necessary to facilitate the AI boom. Think AI chip makers, data center operators, chip fab companies that supply semiconductor equipment for all this AI infrastructure. So the AI infrastructure layer. 15 most important companies there. And then the AI Appliers 15 are what we view as the 15 most important AI applier stocks in the market, or companies that are actually making groundbreaking new AI applications that are transforming our society, proliferating throughout the enterprise, throughout the consumer ecosystem, and actually adding value to companies, businesses, and governments and people. So those are the 3 AI indices we created, and I got a chart of them right here for you. Awesome. Just so you can see how they are absolutely crushing the market. And this is the value of investing in the right stocks, investing in the right AI stocks, specifically as we're talking about these indices. So here in white, you have the AI Foundational 5 index. Now that is up 120%. Our AI Foundational 5 index is up 121% since late 2022. Our AI Builders 15 index is up about 276%, the blue line here, since late 2022, when the AI boom started, right? The AI boom started in late 2022. The AI Appliers 15 index, the best performer of the 3, is up about 295% since late 2022. Meanwhile, the S&P 500, purple line here, is up just 55%. The NASDAQ 100 is up just 97%. The Dow Jones is up just 28%, and the Russell 2000 is up less than 20%. So this, again, is the difference between investing in the right AI stocks, which is, the right AI stocks here, the AI Builders and AI Appliers 15. We're talking 300% returns. Just AI stocks, generally speaking, NASDAQ 100, 100%. And then non-AI stocks, Russell 2000, 20%. That's a tenfold difference between non-AI and right AI. 20% to, well, actually, no, more than that, sorry. 20% to 300%. Huge difference. It's a threefold between the right AI stocks and just, regular AI stocks, NASDAQ 100. This is why we think, again, you got to own not just AI stocks, but you got to own the right AI stocks. And in our view, AI Foundational 5, kind of low risk, low reward, but really good AI stocks. The Builders 15 and the Appliers 15, that's where the alpha's at. Those are the names you got to be invested in. I think they're the cream of the crop of the AI boom. So that's why we built those indices, and we're going to track those regularly for the next, for as long as this boom goes on. And I think it is going to continue for at least the next 12 to 24 months, as we kind of already talked about. So any questions about the Foundational 5, the Builders 15, the Appliers 15? Because I got a few others I want to show you as well. But before I go to those, any questions about these AI stock indices?
Yeah, less a question, more of a comment. For the people that can't see that, you might be listening on audio only, the AI Builders and AI Appliers stock trend are, I wouldn't say identical, but they're roughly the same. And I feel like that really just speaks to the speed in which AI affects the market, where the things you're building and the things that are applying are happening at almost equal rates, and you could profit on both equally at the same time, just crushing the overall market. That's pretty insane.
Yeah, the Appliers and the Builders moved together. They're both up about 300% since late 2022. Again, S&P is only up 50%, so we're talking a 6x outperformance there. And yeah, these are. You got to invest in both, because when anything it's the infrastructure layer and it's the application layer. So you want to be invested in both layers to maximize your exposure to this this trend. I mean, there are moments in time when the builders outperform, like here in April, May, June of 24, about a year ago going into the summer. The builders had a massive rally. The appliers kind of, they went up, but they were more flat. Meanwhile, more recently, it looks like the appliers are kind of taking the leadership baton. Both of them are flying higher, but the appliers are clearly outperforming. That also definitely happened earlier this year. From January to February, the appliers really soared where the builders kind of fell flat. So by owning both the appliers and the builders, you're just giving yourself very robust, diversified exposure to all things AI. You're getting high quality and good diversity. And what more could you want when investing in, a technological megatrend like AI?
Yeah. It doesn't even feel like you're hedging it. You're just maximizing your profits.
It's not a time to hedge, in my opinion. It's not. It's when you have something like AI in front of you, you go all in.
Yeah.
AI with AI is my term. All in with artificial intelligence. And I think that's why these are the big ones for us. The AI Foundational 5, the Bills 15, the Appliers 15. We made some other indices I want to share with you in just a moment, but these are the big ones for us. AI with AI, all in with artificial intelligence.
Definitely.
Now, speaking of some of the other ones, this is another one we created. It's called the Quantum 4. This one's been absolutely nuts. Just absolutely crazy rocket ship type rally. This is what we consider the 4 pure play quantum computing stocks in the market. So you got IonQ, you got Rigetti, you got D-Wave, and you got quantum computing. So IonQ, ticker's IonQ. You got QBTS, you got QUBT, and you got RGTI. So the Quantum 4. And this index is, like I said, it's been nuts, right? The index for us was essentially flat for all of 24, right? This was right around $10, fell all the way to $6 until it started to take off right around September. And then from September 24, it rallied from $6.49 all the way to $100 by January. So a massive, truly stupidly huge return in just 3 to 4 months. And then, yes, you had the big reset in early 25 amidst the trade war drama. But then, look, we've recovered super quickly. We bounced back from a low of about 35 in early March to now we're almost back up to 100. So the quantum stocks have been red hot. They're kind of going in waves. They got really hot in late 24, cooled off in early 25. Now they're reheating. This is an industry we want to track very closely. Everybody's always looking for that next 10x, 20x, 50x winner. I don't know if you're going to find it in the general AI space. You got to get a bit more specific, a bit more niche, a bit more focused. I think quantum AI is where you could find that next 10x, 20x, 50x winner. That's why we created the Quantum 4 index. I don't think all 4 companies are going to succeed. I think it's very unlikely that all 4 succeed, but 1 or 2 of them will succeed in a massive way, more than enough to offset even 100% losses in the other, 2 or 3. And that's going to lead to huge growth in this Quantum 4 index. So we're really excited about quantum computing. It's really starting to come into its own. That's why we created this index. And as you can see, it's, in terms of probably all indices out there, maybe the best performing sort of stock market index you could find right now.
Yeah, that's amazing. What's the ETA on quantum? I think the last time we talked about this a while ago, it might have been 2030 is when we'll see something tangible. Does that still track or what?
Yeah, I would say like quantum AI applications, QAI, which is the stuff I'm excited about. I would say 2030 is a good timeline for that. Before that, we're getting very niche and small applications right now. Companies are building things and testing on top of quantum computers for sure. Like that's actually happening. Right. Tapping into Amazon Bracket and other sort of cloud environments that are hosting quantum architecture. So that's definitely happening right now. But in terms of like real world scalable value additive applications, I think 2030 is a good timeline for that. The timeline here is not super important so long as it's not 20 years away, because the value creation that happens once it hits is going to be so enormous that investors will be willing to look past, a little 2 or 3 or 4 year delay. If it gets to like 10, 15, 20 years, now we're talking, okay, well, now we got to rethink the valuations on these puppies. But so long as we get some useful quantum stuff within the next, I would say, decade,
Right.
I think people are willing to be like, okay, yeah, it's fine if it's 5 to 10 years away, because when it does hit, it's going to be that big. It was worth waiting for. Sometimes the good stuff is worth waiting for, So I think quantum is like that. It falls in that bucket.
100%. Yeah, quantum. It's just mind-boggling to think about that we'll have. I mean, we already have quantum computers, but just on a usable scale, the applications are just endless. Like we'll have true autonomous vehicles. Just I can't even think of everything that we'll get once.
Yeah, I mean, I would say, yeah, true and full autonomous vehicles in all operating environments. Biotech simulation to degrees that we never thought were fathomable, potentially coming up with a cure for every disease out there, using quantum simulations to find new drugs. Maybe things like perfectly optimized financial portfolios at all times of the day, of the year, of the month, of the week, of whatever time frame you're looking at. Unbreakable cryptography, that quantum computers could break current encryption methods out there. But that also means that if we create quantum key protection methods, then those could be truly unbreakable. So just completely safe information, or forever safe information. There's a lot of huge implications that could impact whole $1 trillion industries. And if you do it all together, right, you're adding in trillions and trillions and trillions of value creation. So that's why these companies could be, lottery tickets, if you will. And some of them could be 50x, 100x winners in the next few years.
Definitely. Wow. Yeah. Oof.
The last proprietary index that I want to kind of highlight for you is my nuclear 10 index. It's our 10 favorite nuclear energy stocks. Nuclear energy is having a moment right now, absolutely massive moment. It's just become clear that nuclear energy, why did we frown upon it for so many years? It makes absolutely no sense. It's efficient, it's safe, it's cheap. It's the best. It's the best energy source out there. Arguments against it are antiquated or misinformed. Nuclear is fantastic. And that's nuclear fission. Nuclear fusion is something that could absolutely radically quantum computing could make nuclear fusion possible. Nuclear fusion energy, the combining of atoms, it's the holy grail of energy. It's what powers the sun. If we can really harness that and create that here on Earth, we'll never need any other energy source ever. So you can forget natural gas and wind and hydrogen and all that crap. We just need nuclear fusion. But in the meantime, I think fusion is 5 to 10 years away. Fission is here. It's working. It's efficient. It's cheap. It's scalable. It delivers a lot of power. We're getting things like small modular reactors, which can be used to power individual data centers. And that's really the growth narrative here with nuclear, is that nuclear has become the go-to energy choice or energy source of preferred energy source for AI data center operators. When Meta is going and making new data centers, when Amazon is going and making new data centers, when Microsoft is going and making new data centers, they are now increasingly choosing nuclear energy to power them. And that's really a renaissance moment for nuclear energy. So look at our nuclear 10 index back in early 23, summer 23, it was, $220. Now it's up at $1,000. So, a 4x rise in a little bit over a year. About 2 years, a 4x rise in 2 years. And right now, absolutely just spiking to new highs because you know what? Trump loves nuclear. Trump is realizing the Manhattan Project 2.0, which is this race amongst the world superpowers to build a lot of AI infrastructure. That's going to require a lot of power. And the best baseload power for that is going to be nuclear. So he's signing a bunch of executive orders that are boosting the nuclear energy industry, including easing regulatory approvals for getting new reactors online. That's a huge hurdle, right? Because of all the incidents that have happened in the past, the approval process for new reactors is quite complex. Trump's reducing a lot of hurdles. So this is that deregulation stuff in action, right? It's actually happening. He's improving funding. He's securing the uranium supply chain for nuclear. So nuclear had a great growth narrative before a lot of these executive actions. But now with these executive actions, the growth narrative is just as good as ever. So we have our nuclear 10 index. It's soaring to all-time highs right now, up 4x in the last 2 years. And I think there's there's still more runway left. Really, really bullish on nuclear stocks in the next few years.
100%. That's exciting. I would like to add there was, I believe in the UK, a successful nuclear fusion experiment. Obviously, it was small scale, but it's, now it's in the realm of possibility. And then, like you said, with quantum, the sky is truly the limit. It's easy to just picture like a beautiful world where everybody has everything they need because we have unlimited energy, quantum computers. I'm being purely optimistic here, but you know what I mean.
No, I think there's a reason to consider what we're going into as the age of abundance. Because AI can allow us to create so much supply of things that we could live in an era of massive abundance. And energy, if we live in an era of energy abundance, that would solve a lot of problems. And fusion is getting there. So the thing with fusion is that we can do fusion, but it's not feasible because it requires a lot of energy to make a fusion experiment work. What makes fusion work is like really, 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 really hot temperatures. Again, it's what powers the sun. So we're talking sun hot here, okay? That requires a lot of energy to get stuff that hot. So much energy that the problem with fusion is that when we actually have a successful fusion experiment, the energy outputted is less than the amount of energy we needed to input to create the fusion experiment. Make sense? So the big hurdle there is, can we get a net energy gain? Can the output of a fusion reaction exceed the output energy, exceed the input energy? And there have been a few trial experiments at a very small scale where there was a net energy gain, which is a massive step in the right direction for fusion. And a lot of those experiments actually happened before recent exciting developments in artificial intelligence and in quantum computing. So when you put quantum, AI, and fusion all together, that's why I think fusion is not, a pipeline dream that's 20 to 30 years away, but rather in the next 5 to 10 years, I think we'll get scalable fusion reactors. And interestingly enough, what's his name? Sam Altman, the CEO of OpenAI, is like a huge believer. A huge believer in fusion. And nobody knows more about how AI is advancing, how quickly AI is advancing, and how much value it's adding than him. And the fact that he's such a big believer in fusion really makes me believe, he knows something about AI helping us get towards a fusion reality more quickly than a lot of pessimists would like to believe.
Right. Yeah, just, technology is an amazing thing. You can't believe all the pessimism in the news. The world is ending, yada, 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 yada. When we have just almost literal magic. What's the Asimov quote where a sufficiently advanced technology is indistinguishable from magic? Like we're almost there. And some aspects we're already there. So just be optimistic and buy AI stocks, right?
For right now, that's the game plan. Like I said, eventually the boom's going to turn into a bust. You got to be aware of that. I'm watching the IPO market for that, but right now I'm not seeing the red flags. And so, I think AI with AI, all in with artificial intelligence and all the related industries. That's the game plan.
Awesome. Was this the last indice, Luke? Did you?
That was the last. That was the last. We have other proprietary indices that we're gonna build out and talk about more in the next few weeks. But for right now, foundational 5, appliers 15, builders 15, quantum 4, nuclear 10. I think that's the core of what we built so far. Yeah.
Awesome. So if that's the case, I'd love to dive into more specific stocks. We got a couple of new ones this week.
Yep.
I think we are starting with CRWV.
Yeah, CoreWeave, AI infrastructure company. We kind of talked about them earlier. This is one where there was a successful IPO in the AI market. And look at the stock. I got the chart for you pulled up right here. IPO'd right around $40. Now it's at $120. So 3x from the IPO price in 2 months. Wow. That's sensational. That's amazing. And this is one that I really do like. This company is growing revenues Let's see, 2026 expected revenue growth is 130%. After that, we're going to 40%, 23%. This is a massive grower. The company rents out GPUs to the big boys. So they buy a bunch of NVIDIA GPUs and then they rent out that space to the Amazons and OpenAIs and Microsofts of the world. They're really tied closely to OpenAI. So the more success OpenAI has, the more success CoreWeave should have. Again, a triple-digit revenue grower. I think the company is really, really solid. And when I look at the valuation, technicals are obviously really extended. RSI of 82, and it's kind of running straight line vertical up. So I don't know if I would chase the rally here at 120, but I think this is one you do want to buy on all dips because, again, looking at the valuation, we're only at 4 times 2026 estimated sales, and those sales are growing 100% plus year over year. So 4 times forward sales for a triple digit revenue grower, that seems pretty reasonable to me. And because of that, I think that, hey, this stock actually has a lot more runway ahead. It also has potential to be super profitable as well. The business model itself is inherently high margin. So I like this company. I like this stock. I think it's a good AI builder. It's not in our AI Builders 15 index. It's too new, but I do think it is a great AI builder stock. This is one of those exponential winners that I think has more exponential runway ahead of it, if you will.
Yeah, definitely. Man, on paper, that team really just nailed opportunity and action. They were at the right place at the right time. That's nuts.
Yeah, they IPO'd right as the trade war was kind of calming down and some animal spirits are coming back into the market, and it had a great earnings report. So yeah, in terms of timing is everything. Yeah, that's that speaks to that.
And I see you got the next one pulled up. We talked about it a little bit earlier. IonQ.
Yeah, so this one's been on an exponential move higher too, right? This is let me get the annotate button up here. We are up 154% in 54 days, 54 trading days since March 2nd. So 2 months and change, up 150%. And obviously this last week, we're up about 30% because of that in Barron's article and NVIDIA of quantum computing quote out of the CEO. So huge growth happening here. Very extended in the short term, technically. 80 RSI, MACD really blown out in a positive direction. Coming into what could be some major technical resistance right around the previous high at 51. So maybe the stock runs to 51 and then cools down around 51, very natural consolidation point. But in terms of a long-term growth investment, IonQ is rock solid. They are the technological and commercial leader in the very promising quantum computing field with a massive addressable market and a huge revenue growth runway ahead of them. That's the sort of firm that you buy as a long-term lottery ticket. So I think the stock is a big time winner. When you talk about sales growth numbers, 25 sales growth estimated, 95%. 26 estimated, 97%. 27 estimated 70%, 28 estimated 77%. So you're looking at over 70% revenue growth per year for at least the next 4 years. Yeah. And that could be still by 2028, you're looking at 500 million in revenues. That could still be the very early innings of what could be a company that becomes, tens of billions of dollars, if not more, in revenues. And the market cap right now, I think, is just about, what's the market cap? Last check, it was 10 billion, but it's been going higher so much. Yeah, now it's 11.3 billion. So $11.3 billion market cap. Yeah, it's expensive if you look at just the sales today, but you look at the potential tomorrow, I think there's a lot more potential for this one to grow. So I like IonQ. I think it's a long-term winner. Speculative, high risk, but if it works out, this one's going a lot higher than $50.
Definitely. Yeah, 11 billion now for potentially a world leader in quantum computing in 5-10 years. That's, I'm not going to say it.
It's big time. It's big time. Let's move on to the next one. We got NuScale talking about kind of already hit quantum and nuclear. Now we got another nuclear name here. SMR, NuScale Power. They're creating those small modular reactors that can be used to power individual data centers. Their power output is about the exact type of power that you would need to run an average AI data center. So that's the growth story here. That this company is going to build a bunch of SMRs to power all these new AI data centers across America. Love that growth story. So does the market. Stock is on an exponential move. Exponential money being made in this one off the early April lows about 2 months ago. We're up 180% in 35 trading days. Absolutely ridiculous move. Took out the previous high, kind of knifed through it like butter. No resistance really at $30. Straight through that. Now we're up to 35. RSI is 87, so super overbought in the short term. I'm not sure I would chase this one, but kind of like IonQ, kind of like CoreWeave, this is probably a buy on dips name. $8 billion market cap for a company that could be creating the new backbone of energy infrastructure for artificial intelligence, growing at only 27% revenue growth this year, so they're just kind of getting started. But once they start ramping up, 26, you're looking at 230% revenue growth, 27, 144% revenue growth. So some big numbers over the next few years. 10 times estimated 27 sales feels rich. I understand that. But if this company really is developing SMRs that could power all of these data centers across America, then $8 billion market cap feels pretty small when you look at other energy giants like, Constellation Energy. What's their market cap? Let's see. 93 billion for Constellation. Vistra, another big utility company, their market cap is 53 billion. So this one's 8 billion. If this one can grow up to be a utility giant, and I think it can be, I think it's a stock that is a buy on dips going forward.
Yeah, definitely. And then even if it's overbought, you're kind of dollar cost averaging it anyways, because we already know big money's going into nuclear.
Big money is going into nuclear, and that's why another stock that came up this week on our scan of sort of these exponential winners is another nuclear name called Oklo. Oklo is the company that Sam Altman was a part of. He actually stepped down as the chairman of the board because he wanted to allow the company to strike some AI data center deals with companies outside of open AI. Makes sense, conflict of interest type thing. So remove that conflict of interest, step away from the board. But still a majority shareholder, huge believer in the company. They do fission, they do small reactors as well, kind of nano reactors as well. So this isn't fusion, it's still fission. But the company has a very promising future, a lot of potential AI data center deals in the pipeline. Again, though, very overbought, 83 RSI, coming in some major resistance right around 55, the previous highs, double top back in February of 25. So we're at 54 right now. This is a natural place for it to cool down and consolidate, but probably another one that you want to buy on dips. Like the stories behind these companies, CoreWeave, IonQ, SMR, Oklo, they're really strong long-term secular growth stories. So again, these are stocks that, yeah, they're speculative, they're high risk, you could lose a lot of money. I recognize all that, but the growth stories are good enough to say, hey, it's worth the risk. Don't chase them when they're super extended, but when they come in and people start to doubt the growth narratives, then you buy them on that dip, kind of like they did in March, April 25 with a lot of these names. And then you ride them higher for the long term. So that's kind of how I'm viewing Oklo. Same boat as CoreWeave, IonQ, SMR. Really good long-term story that's worth buying on dips.
Gotcha. So we kind of view these as not trading opportunities. These are long-term opportunities if we get into them.
That's how I would view them. There's trading opportunities within the long-term growth. And when you look at some of the moves these guys have made in a short amount of time, that kind of says, hey, these stocks do present some powerful trading opportunities. But for now, they're I would say, they're just long-term holdings.
Definitely. And this last one, I thought it was funny. You sent me this list, and I was like, oh, cool, awesome stocks. And then Advanced Auto Parts.
Yeah, AAP, baby. Advanced Auto Parts. It totally fits the same narrative as CoreWeave, IonQ, NuScale, and Oklo. No, it's totally different. They had a good earnings report. And in response to that earnings report, the stock absolutely soared. I mean, from $31 to $50. This is a company that was going to get hit hard by tariffs and all that stuff. And now it looks like maybe it's not going to get hit so hard and they're going to be all right. A little bit of a recovery story. Zooming out and looking at the chart, I mean, it put in a pretty durable bottom. But you can see how beaten up the stock is. I mean, absolutely destroyed. This was a $240 stock back in 21. Now it's 50. So the bounce that we're seeing right now, huge bounce if you zoom in, up 25, 30% in a few days, but looks like nothing on the long-term chart. Stock is still stuck below its 200-day moving average. To pull that up for, actually, it bounced above its 200 days. So that's a positive. But I'm just not a believer in this one. Nice bounce, but looks like a dead cat bounce until it proves it otherwise. So I would, this is not a core weave. This is not an IonQ. This is not an SMR. This is not an Oklo. This is just a company that got a dead cat bounce. The stock got a dead cat bounce. I wouldn't be chasing it. I don't think it's an exponential move. I think it's just a singular bounce higher that probably will get faded.
Definitely. Interesting. Yeah, it looks like it never really covered from the that bad market we had in it's 2022, right?
That's right.
Wow. Okay. And does this cover it for our exponential stocks this week?
Yeah, those are the ones that kind of came across my radar this week as big movers in the past week or so with interesting stories and what happened to them. Like I said, what we saw last week was that a lot of long-term growth stocks got a big bounce. And I think that could be the start of a big move higher across the industry of long-term growth names, whether that's emerging nuclear energy, whether that's emerging quantum computing, whether that's emerging eVTOLs, these flying cars, whether that's emerging robotics makers. I think you're going to see some big rallies in those names. And again, that's consistent with, 7th, 8th, 9th inning behavior of a tech bull market. The long-term speculative names start to really heat up. IPO market heats up. M&A activity heats up. I'm starting to see the beginning signs of that. But that party can last 12 to 24 months. So the fact that I'm starting to see beginning signs of that is not worrisome at all. Once it gets really hot, then we got to reassess. But for now, I think things look good. And I like the direction and vibe of this market right now.
Awesome. Yeah, fantastic. Yeah, it does feel like we're at the base of a springboard here, just with all the different aspects coalescing. Consumer confidence, trade wars behind us. You just got to be aware, right? We talked about that earlier. Mm-hmm. Awareness is key. Do you have any other final remarks for this week? Anything we're looking forward to?
I guess, you talked about it at the top, but really the big thing is just, hey, the purpose of this podcast is to identify exponential technological trends that allow us to become more productive and make money and just, be better people overall, really, while ignoring the noise of trade wars and all this other stuff going on. And I really want to emphasize that this week because it really does feel like the trade war is in the rearview mirror. And with it in the rearview mirror, that should allow the market the breathing room to really refocus on what are a lot of really exciting emerging exponential technological trends right now. Quantum computing, nuclear energy, eVTOLs, biotech AI, things like that. So yeah, let's do that. Let's do that with the market. Let's refocus on these trends. Let's find these winners because they're soaring. I mean, all the stocks we talked about this week, CoreWeave, IonQ, SMR, Oklo, they're up more than 30% in the past 5 trading sessions alone. Those are huge moves. The market goes up 10% a year on average. So you're talking 3x the average annual market return in 5 days. That's what's happening right now. So please just back out the trade war noise, back out the political noise, focus on these tech trends, and let's find the winners and let's make some money. So that's my big message. I'm going to continue to hound on that big message for the next, for as long as this boom lasts. And like I said, I think we got at least another 12-month runway here, if not up to 24, 36 months until this whole thing pops. But for at least the next 12 months, I think it's all systems go. I think we got to find the big winners in these tech trends and ride them to the top.
Amazing. Yeah, let's make this money. That's it. It's been another great week. Appreciate you again, Luke, for breaking down all the knowledge. Just making it easier for everybody. I know I'm going to update my portfolio, but that's been another episode of Being Exponential. We'll see you guys next week.